Hi, I'm Keith McCullough. Welcome back to our contributor call, which is our new partnership with Seeking Alpha, where it's my pleasure to be with Chris Sommers, who is both the founder and a portfolio manager at BluePac Partners, which is a hedge fund that he runs out of Bedford Hills, New York. So Chris, first kind of getting into what you want to get into, which is the bear side of something, Deere. I just wanted to give you kind of the opening volley on kind of the 90 seconds, if you can, which is based on much more work than that,
Sure.
on what the top-down thesis is.
Sure. So basically, Deere sells large tractors, and in the last 6 years, the sale of large tractors has been running at a dramatically higher pace than any long-term normalized average. And the number of tractors is directly tied to the amount of farmland being planted in the United States and globally. So what we've had happen as tractor sales have kind of been through the roof is the average age of the entire tractor fleet is now at basically a record low level. And so assuming we had a sustained high-priced crop environment, it would be unlikely that farmers would need to continue at the pace of tractor purchases as they had in the past. And now that we've had the crop prices fall dramatically, corn's down over 50% and soybeans are down over 40%, farmers have to look for ways to cut costs because fertilizer prices are still high, seed prices are still high, and the very first thing they're going to cut is equipment costs. So of all the farmers I've surveyed, none of them are going to buy new equipment next year, and almost all of them have bought new equipment in the last year or two. Now what's interesting about it is, a lot of people might look at this situation and say, okay, fine, I'll just wait for the earnings to be bad next year, and then I'll buy on the trough, and even if they only earn $4 a share, the stock's at 80 today, they'll go back to earning $8 or $9 in a couple years. Well, in order to get the age of the tractor fleet back to historical averages, Deere's sales would probably need to fall 40 to 50% and stay at that depressed level for several years. The math would suggest 5 to 6 years.
So typically people that are in stocks like this, they're not cyclical investors. They think that the trough occurs immediately, and what you're saying is that there's a much longer term cycle to farmers' income, their purchasing patterns, this new innovative product that is, by the way, very productive, that they may not actually need a tractor.
Well, more or less, the gist of it is that a tractor's average age is 15 to 20 years. And maybe the bigger farmers that have the higher incomes will buy a new tractor in a normalized environment every 7 or 8 years. And then the smaller farms would buy the older tractors, and that way all the tractors stay at like 15 years to 20 years before they're retired.
And you're talking like traditional cycles. I mean, this is not giving any benefit to what Deere's actually selling, which is a highly innovative and productive tractor relative to the prior cycles and the age of the fleet.
Well, I don't know that the tractors are dramatically different today than in the past, but it gets back to the point that, like last year, for example, 2013, there were 44,000 tractors sold.
In the U.S.?
In the United States. In the 1980s, there were 24,000 tractors per year sold on average. In the 1990s through the early 2000s, farmland actually shrank, and there were only 22,000 tractors sold on average.
Wow.
So we were running almost twice as high as a normalized average last year. And not only does that double your sales relative to where they would normally be, but you also get this massive margin benefit.
Massive, yeah.
Yep, and that's because you're producing things as quickly as you can, and so your productivity for your labor is sky high. You have pricing power because your customers have high demand, and there might be wait lists to buy tractors, which there were. Guys that ordered tractors this summer won't take delivery until January of 2015. So Deere sales won't even really fall off probably until starting in the second quarter of next year, because they have this backlog because farmers still had a lot of money from last year.
So if you kind of look at this, I mean, and that's what you're really looking for as a short seller. You're looking for peak, peak, peak. Peak sales, peak expectations, peak margins. If you're looking at the sales growth, on a revisionist basis, what was the peak sales growth for Deere, and what do you think it could trough at ultimately?
Well, Deere's sales obviously more than doubled in the last 6 or 7 years as tractor sales more than doubled.
So it's massive run.
Yes,
it's massive.
Huge. Yeah. And with a cyclical company where you have what's like a discretionary capital good item, it's really hard to talk about what like a normal sales level is and the normal growth level in the context of what's happened recently.
Yep.
It would be like looking at the housing market in 06 or 07, which I actually think is a good corollary to what we're seeing in ag today.
Because it's like a bubble. I mean, you look at the peak of corn prices as a leading indicator for the bubble of spending in that sector or subsector of the economy. It's a lot like how our mining analyst talks about CAT. You know, and you're selling the highest margin thing that you could sell, which are just huge pieces of equipment, into the peak of the cycle. Is that
exactly? That's exactly right. And so, like long term with Deere, they already have a very high market share, which they don't disclose, but it's estimated to be in the mid-60s. So,
wow, it's huge.
You know, in the long term, what is their long-run sales growth? In North America, it's really like maybe modestly negative because cropland going forward will probably decline again because over time the productivity of the land outpaces population growth and food demand. So, you know, in the early 1980s, we had 260 million acres of cropland, and in 2004, we only had 215 million acres of cropland. But food production went up 50% in that same time frame because, you know, today an acre of corn or an acre of cropland might yield 175 bushels of corn, and in 1970s, that same land only did 80 bushels. So, you know, tractor demand over the long term is really going to be pretty steady, and I don't know that there's a lot of room for them to gain share going forward.
It's not an exciting growth story after the peak. I mean, really, from a top-line perspective. How about on the margins? How far could margins compress on any kind of degradation in sales?
Sure. So at the peak of this cycle, when they've been running really hot and really hard, margins in their ag and turf division, which is the farmland tractors, has been in the high teens, mid to high teens. I think it was 16% last year. If you look at what happened in prior cycles,
You're talking about EBIT margins, or are you talking
operating profit margins? Yep. In the 80s, the margins were basically zero during the trough.
So they can go to zero. Like, I mean, it can get, that's nasty. I mean, that's when you have the Federal Reserve raising interest rates, commodity prices collapse, and these guys have no margin.
Yeah, well, what happens is during this big upcycle, and you can see this if you just analyze the cost of goods sold, and you can ask the company, and they'll tell you, you know, a third of the cost of goods sold or 30% of the cost of goods sold is, you know, labor and things that are relatively sticky fixed costs. And when you have a massive drop in sales, you have all these employees and all these factories that you had to add capacity to double your output in 6 years' time. If output drops by 50% back to a normalized level, you have all this excess capacity, and that takes a long time to reduce those costs again via layoffs and reconsolidations and things like that. And those charges cause margins to go to zero, and also just a lot of that overhead absorption can hurt margins. I don't predict that it will get that bad. I actually model a 5% margin for the trough average, which is 110 basis points better than the prior trough in the 90s through early 2000s.
That's a long way from here, man.
Yeah.
A real long way from here. How about on the finance income piece, which is kind of an interesting piece that you'd have to do a lot of your own work? How cyclical or pro-cyclical is that?
Well, the interesting thing about the finance piece is it's currently a pretty large contributor to their earnings. They're going to probably generate $1 billion of net income this year, which is over $2 a share of the earnings, which I think analysts have at $7 or so.
$1 billion bucks in just P&L from finance?
Yep.
Wow.
So what's happened in the last 5 years is they've financed a large portion of the sales of these tractors, and if you look at the cash flow statements, you'll see that, ironically, despite the fact it's been like the 4 best years to be selling tractors, they've generated very little by way of free cash flow because it's all kind of been plowed into the receivables book. So now they have record high receivables, but if sales fall, the receivables will fall as well because they're financing less and farmers are paying off loans. So you would see the loan book shrink dramatically, and so you actually have this pretty visible headwind in terms of finance income ratcheting down year after year after year, going from $1 billion to maybe $800 million to maybe $650, then down to, I estimate normalized finance income would be $450 to $550 million. So, you know, you can lose $1 a share of earnings right there.
I mean, that's why you're such a great analyst and how you kind of thought it through. It's certainly not your first rodeo. You worked at Greenlight. You're very well trained, but you think about this in terms of, okay, top line's at a cyclical top, margin compression. Then I have this other bucket that is misunderstood in earnings. So that gives me the kind of smackdown in P multiple compression at a bare minimum. How do you think about that versus the behavioral side to this, which is you have 10% short interest in the stock. It's had some issues lately. It hasn't collapsed, but it's certainly not a low short interest stock. For a big cap stock, $30 billion in market cap, 10% short interest, there's got to be other people out there who are onto at least components of what you think.
Yeah, so it's a really interesting psychological market case study because
which you got to go through, right?
Yeah, there's a lot of people that understand that equipment costs are going to be the first to go.
Yep.
And these people are bearish on ag, and they want to express that view. So instinctively, they think, I want to short Deere or C&H or some of the other.
Well, there's very few big cap liquid ways that a hedge fund can short ag. You know, in many cases, that's actually a risk, is because you have dumb shorts. They just have it on, and they don't fully understand it.
Yeah, I actually think a lot of the shorts in the name are probably more of a macro thematic guys and less of guys that have a view as strong as mine or as
well, I've looked at it. It's not detail oriented. It's not bottom up from the model perspective. I mean, you have your K's and Q's in front of you. That's not the view. It's a macro view. That's
right.
fair. I think you could say, I don't know what percentage, but 50 to 60 to 70% of that short interest is there, but it's not exactly what I would call like an intelligent short thesis. Do you think they could get shaken out short term? Or?
I think most of those guys are in it for 10 to 20% down moves.
Yep.
And then you have this whole set of guys on the value side that haven't done a lot of work either that saw the $9 a share of earnings last year. They see $7 this year. They think maybe trough is $6. And they have the feeling that they want to buy. And they think, oh, if I can buy this in the 70s, that's 12 times trough. And then 3 or 4 years from now, it goes back to 9 or 10. This could be $100+ stock at some point in the future. So you have those guys too.
Yeah, which is equally dangerous.
It's equally dangerous. But
and it's in all the index funds. I mean, in the 10% of the shares held are by State Street and Vanguard, so there's no work being done there.
Yeah, I don't know about that.
I mean, maybe not this kind of work.
Yeah.
I shouldn't say that, it's being impolite, but if it's in a passive index fund, I mean, that is what it is.
Right,
exactly. So
yep.
you got that too. But you also have Cascade in there for 9% of the shares.
Yep.
Is that Bill Gates'
Yep, that's Bill Gates' private fund. Bill Gates isn't involved, but he's had this manager there that he's had since the 90s. That
obviously owns
people
a lot.
know. Yeah, people know little about those guys. I suspect that as time goes on, they'll probably, or who knows, but the research and analytics into the short case is pretty straightforward because the tractor data is readily available, and I think anybody can see that when tractor sales had been at X forever and then just went to 2X for this period when crop prices were really high, and then you also know that the average age of the tractor fleet's at an all-time low, it just kind of makes sense that it will have to revert back and possibly overshoot. Then you've got to build a model and say, well, what will the earnings be then? And the disconnect between me and the value guys that are waiting in the wings to buy this in the 70s is I don't think trough earnings is $6. I think it's something well less than $3 on a reported basis with all the charges, which they'll pro forma out, of course. It could easily be 0 or negative like it was in the late 90s and for a couple of years in the 80s.
And even if it isn't, I mean, we do have the behavioral experiment that was 2012. The stock went to 65 on commodities finally going down after hitting the epicenter of all-time bubble highs in 2011. So you do have like some kind of, if some other guy who doesn't do any work at all is just looking at a chart, he's probably looking at 65. But you're saying that it's probably got more downside than that.
I think that given everything that you can take into account, fair value in my mind for the market is somewhere in the 40s or 50s.
Wow. Yep.
But the trough will persist. It could persist for several years, and during that time, there may be very little by way of good news, and it could easily overcorrect well far below that, which would then be the time for the value guys to get in. In my mind, if I were a value guy looking to buy this stock, I would be looking in the high 20s or low 30s.
Wow. That would be value.
But hedge funds presumably have a higher cost of capital than most of the market.
Yeah.
So.
Well, I mean, people are so outside of themselves in terms of where stocks can actually go if the cycle goes negative, if macro goes negative, if the Federal Reserve money printing is no longer a catalyst. I mean, there's so many different things here. But you've analyzed the cycle, you've analyzed the company, and that's your view. So I applaud you standing out there on your own. And he's Chris Sommers, and I'm Keith McCullough. You can find me at Keith McCullough is my Twitter handle. Our @Seeking Hedgeye handle is right there, too. You can also find all of Chris's work on Seeking Alpha's website.